In this week's update, an extraordinary mix of positive and negative signals. Silver explodes to historic highs, and commodities, well, they're just going gangbusters. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. What a week. What a month, to be honest. It's been extraordinary for commodities, and I'll get to that, but there's other things going on which are also really important that you need to know about. This is not an extensive list. I'm just covering the ones that you may not have necessarily come across in the mainstream. Firstly, there's been an absolute rout going on in the Japanese bond market, and that is set to cause, if it's not already, huge disturbance to the way that money flows around through the various asset classes around the world. Because for the last multiple decades, money has been borrowed in Japanese yen at almost zero interest cost and then invested elsewhere to get a higher return. And it's what's been called the carry trade. Now, that has been threatened on and off a couple of times in the last couple of years, and it's always been quite disruptive to markets, and it's certainly heading that way again. And I'm surprised that there wasn't more of a market reaction last week to that. And when we think about Japan, we've got one of the world's most indebted governments, and they're proposing to cut taxes and boost spending, and that's what's led to the anxiety in the Japanese bond market. So I think there's almost certainly more to come in that story, and it's hard to see that it's going to be all that positive. And then on top of that, we add in all of the flashpoints around the world: Greenland, Venezuela, Middle East, Ukraine, and then, of course, Donald Trump doing a wonderful job with trashing Western alliances as well. So it's a cocktail of extreme proportions. That's what you get. You get a whole lot of uncertainties. And again, I'm just surprised because markets hate uncertainties. We've got it in spades, and yet the market outlook seems to be fairly calm. And I think it's because the megatrends are just perhaps so strong that they're just swamping out these other effects, and we're not seeing much of consequence from it. The 7 megatrends as I define them, and from my perspective, not only were they strong and pretty much unstoppable anyway, but what's happened in the last few months is really only going to enhance those megatrends. So that's perhaps why markets are as relatively calm as they are. So the conflicting mix that we've got at the moment, particularly in the US, which obviously sets the tone for the rest of the world, so we've got to pay attention to not only what's going on there, but also what the thinking and the sentiment is. So we've got broad US earnings strength, and that's pretty much undeniable. And share prices have been going up for very good reasons, because companies are going along very, very nicely. We've also got a number of resilient US economic fundamentals as well to support that. So this is a lot of these gains that we're seeing in US stocks, particularly in the sub 50 billion market cap part of the market. This is real earnings. This is real cash flow. This is not speculative fever. And therefore it's likely to continue as long as these conditions do. But of course, what we also have going on, as we have for a few months, is that we've got a valuation reset, and that is still happening. But the good news is that it's rotating down to the smaller end of the market where greater value exists. So we're getting the opportunity to buy great momentum, and we're not having to pay through the nose for it. But against all those positives, we've got extreme geopolitical risks. So all of this just supports the continued rotation that we've got out of high multiple tech stocks and a few other sectors, but there's no panic sell-off. It's just a calm, orderly rotation. This is a wonderful market. We haven't had a market like this for some time. So the objective here would be to selectively buy. You've got to be very careful about the stocks that you buy, because this is not everybody is in the pool together. You've got to be very selective. But dip buying to a plan, to a coordinated plan, is likely to produce pretty good results. Now, we also advise that before you take anything out of this video, that you make sure that you've got all your other investment, financial and legal advice that you require, because particularly in volatile markets, you can and will suffer loss of funds if you're not organised. Let's look at the American market now. The S&P was down a bit, 0.5%. The Nasdaq down by just a tiny sliver. The Russell pretty much the same as the S&P 500. But when you look at hundreds and hundreds of US charts, particularly in the sub 50 billion market cap category, you see a very different picture to the Russell down 0.35%. I was really quite surprised because I've been spending the whole week looking at these hundreds of incredible uptrending charts with the most powerful momentum, and then to see that the index gave back a little bit. So as I've cautioned many, many times in the past 18 years that I've been doing this, you don't want to rely on what the indices are doing, and yet most of the media just reports what the index is doing. So how can investors not be misled? Now, the US dollar index fell. It was getting close to 100 a week or so ago. We're now down to 97.5. It was down 2% for the week. And in currency markets, that's big. That's a big move. The 10-year yield was up a little bit from 4.18 to 4.23. The VIX spiked to 21 during the week, finished back at 16 after Donald Trump kind of backpedaled on some of his most aggressive and outlandish statements. So let's go and look at some US charts. We'll start with the Nasdaq. These are all on weekly charts for the US. So the Nasdaq just down a fraction, but it's still within this ascending triangle. And one would think that there's every chance, in fact, the odds, it's all we've got in the market. We've got odds and probabilities. The probabilities favour this breaking to the upside, and probably not too far away. I'll just whiz through to the semiconductor ETF, SMH, because that's always a good bellwether of what's going on. And despite the rotation out of high multiple big tech stocks, we're still seeing the overall semiconductor sector holding up extremely well. I mean, this is just tracking above the 8-day moving average, which is a sign of enormous strength. And the lows, the troughs in the overall uptrend are only just going below the 20-day moving average. So whichever way you slice it, this is a very, very strong uptrend in semiconductors, and that's good for technology as a whole. Now, if we look at the S&P, again on a weekly chart, down just a little bit more than the Nasdaq, but we're almost on all-time highs. Now, the RSP, similarly, we basically are at all-time closing highs. And there was the Russell down a fraction, but as you can see, it had been trading up quite strongly during the week. So that's the way the US market sets up at the moment. We'll just check the currencies. So the US dollar on a weekly chart. So that's quite a sharp move. And we've really got to go back to April when Trump was at his magnificent best with tariffs left, right and centre, until we've seen a move down in the US dollar of that extent. And one would think that this is just going to continue. So we've had a consolidation in the US dollar that started in April. It's really just gone up and down within a band between 96 and 100. But the overall trend is down, and certainly last week did nothing to change that. Now, the Australian dollar has finally got a bit of a scurry on because of two things: where the US dollar went, but also because of the strength in commodities, which is getting very broadly based now. So no surprises there. Moving to the Australian market, the Aussie dollar 68.3, that's where we finished. So that was quite a good surge in the last few days of last week. Our index fell 0.5% for the week. And I particularly want to look at the emerging companies index, so the smaller end of the market, and also the resources sector. So putting those two things together is a real magic formula at the moment. So let's go and look at the Australian market. So we'll start first of all with the ASX 200. And this is on a weekly chart, so you can see we've been trending up the last 6 or 8 weeks. Just a little bit of a backtrack. But one would think we're more likely to open up a little stronger on Monday morning. This is the XCC Emerging Companies Index on a weekly chart, and just look at what's been happening since the end of November. So basically the last 2 months has just gone straight up at a great rate. And look at the volumes increasing as well. Banks have sort of been in the middle. They're just appearing to maybe be rolling over, which would make sense from a fundamental valuation point of view, but you never want to hang your hat on that. But it's this index also to go with the smaller end of the market is where the real action is. So this is the resources, ASX 200 resources, and that's gone in a straight line as well. So the opportunities in the Australian market at the moment are just wonderful, and it looks like they're going to continue for some time. It's really hard to see this momentum, even though some prices have doubled and tripled in a very short space of time. It's really hard to see what's going to get in the way of it because the commodity strength has been so robust that these stocks haven't caught up yet. They're trailing what's been happening in the underlying commodities. So quite an extraordinary market. Let's go look at precious metals. This is silver on a weekly chart. So we last saw a major peak in silver in April of 2011 at about $50. We've just rushed up to $50 in the middle of October. We had a pullback and a little bit of churning around there for a few weeks. I'll just tighten in on that. So we had a bit of churning for a couple of weeks, and then it took off again at the end of November. So again, in 2 months, it's just been an extraordinary rise, and that is what happened last week for silver. I'll just put this on a daily chart just to give you an idea. So Friday was as strong or stronger than any other day. So silver stocks in Australia should open on Monday morning in a very, very buoyant fashion. There's the US dollar on a weekly, the gold price in US dollars on a weekly chart, and we're within a whisker of 5,000. It closed at 4,988. So only $12 off the 5,000 mark, and translate that to Australian dollars, and it's just huge. And it's going to be amazing to see the commentary that goes with the Australian gold miners when we come into earnings season. And we've already seen a little bit of it already. Companies like Evolution Mining have been out with some pretty good reports. But in Australian dollars, we closed at 72.35, which is just incredible. So let's just summarize what happened in the precious metals market. So gold put on nearly $400 for the week. I've kind of got used to saying 100 or 150, but nearly $400 for the week, up 8.6%. 72.35 in Aussie dollars. Silver was up 14% to 103, so it finished over the $100 mark. And the gold to silver ratio was now plummeted below 50. Let me go and find that chart. There it is. So the long-term average, depending on what source you use, is somewhere between 50 and 70, the ratio between gold and silver. Now, we've just been plunging almost vertically since the end of November, and we've gone from 80, the ratio of 80 ounces of silver to every ounce of gold, and now we're down to 48. So silver has been doing a massive catch up and is perhaps overshooting some of the long-term relationships, but that doesn't mean that it has to stop. It can continue as long as the momentum is there. And the other point that I want to make is that unlike a lot of bull markets in gold and in gold stocks, there's a lot of speculation, there's a lot of froth and bubble. This is more based on fundamentals, structural fundamentals that have changed, perhaps for good, but for a very long period of time. probably at least a decade. So this is far from a speculative excess exercise. Now, if we move away from the underlying metal and into the actual stocks themselves, the miners and the developers, GDX ASX was up another 7% last week, and that was on 7% the week before. And I reckon we're going to be pretty solid when we open. So I think there's going to be more to come in this week that's just lining up. So the question I'd pose to those who are viewing this is, what's your plan to capture this? Because it's not just going to fall in your lap. It might fall in your lap for a little while. You'll make some really, really great profits and you'll be rubbing your hands. But I've been mentoring traders and investors for 20 years, and the thing that I hear almost all the time at the start is that traders and investors don't know how to take profits. They've got no idea. And the number of war stories that I hear about making 5 times your money and then giving it all back because you just didn't know how to get out. So I just pose that question to those listening to this. What is your plan? And the elements of the plan that are critical, you need to know what your total weighting to precious metals will be and the number of holdings that involves. And that all needs to dovetail into the overall plan. You then need to make some decisions about the style of holdings that are best suited for you, that will allow your psychology to be at ease. And don't underestimate the importance of your psychology in the market. It's critical. Then we get down to the level of specifically qualifying the best of the best targets, whether they be existing producers or developers or early explorers. They're very different. They're as different as chalk and cheese. So just thinking about buying some precious metals stocks in general is nowhere near good enough. And then the final thing is you need to know what your entries and your exits look like. Now, we don't know where they are. We never do until they arrive. But what you've got to do is you've got to understand what they look like so that you can spot them when they come up. It's pretty basic stuff, but in my experience, almost no one does this. And yet it's simple, it's basic, and it just gets you on the right track. Turning now to other commodities, copper got down to about 580, but bounced again back to 594. And what we've got here with copper is an incredible long-term structural outlook for decades. It's going to take them a decade to catch up, if they even manage to do that, to the demand, and then another decade to try and keep pace with it. So we've got an incredible long-term outlook that's underpinning this. But technically, some copper stocks are getting a bit stretched. Some of the producers are getting a bit technically stretched. And therefore, in the short term, they're at some risk. But thinking out over the next couple of years, buy the dips, I think is going to get well rewarded. But again, you need to know what the dip looks like. Is it a little dip or is it a bigger dip? And then the most important thing, and that's how do you stage your exit process? How do you go about it? What are the triggers? What has the market pattern got to look like to signal that you should reduce your exposure? You need to know this stuff. West Texas Intermediate crude, 61.28, bit of a bounce. So we've got an interesting but very uncertain environment where we've got a broad glut of supply. So that would tend to push prices down. But we've got this intermittent geopolitical risks that are just popping up almost daily. So the oil prices are getting kicked around. So it's very, very difficult to feel at all positive about the oil market. So for me, as I said last week, I think this is a very poor market for investors, but it could be a good market with all this volatility for traders. But again, traders with a plan, not some wannabe traders who think it might be a good way to make some short-term money. There's the copper chart. So we're getting a bit of a bounce. We've had a breakout. We've got a great medium-term trend there. Nickel also rebounded last week, particularly towards the end of the week. We're almost back to 19,000. There's aluminium, also a little bit of a dip and then a bounce. Spot uranium is doing really well, back up to 88. So things starting to bubble in the uranium market, and certainly the uranium stocks are really gaining some momentum. And there's the crude oil chart. So wrapping it all up, if you haven't got a plan, then I'd be very confident in saying, and I don't take any pleasure in this at all because I like to see people succeed, but expect to give most of your profits back. And I say that because that's what I've been told by hundreds and hundreds of traders and investors. If you don't have a plan, then that's what happens. And if you look at silver, it's highly likely that we've got incredible gains ahead of us, but there is going to be extreme volatility. You can't move commodity prices and stock prices to this degree and not have volatility. It's impossible. So we're going to have extreme volatility, but the overall direction, I'm also confident, is to the upside. So again, the question is, are you equipped to handle that? And by that, I mean, are you organised enough? And if you're organised, then that helps settle your psychology. So the future, from a big picture point of view, is becoming pretty clear. Certainly nothing that's happened in the last few months has dispelled this probability and this journey that we're on now, and that's one of deglobalisation. And if you think about it, that means that we're going to have massive duplication. There's going to be countries that were relying on other countries to supply them. They're now going to have their own industries again. And so we're going to be duplicating, particularly on critical metals. We're going to be duplicating all over the place. And that's in a commodity world that's already stretched in terms of supply and demand. And the West is just waking up to the fact that they've been asleep at the wheel for the last 3 decades. So just think about what that kind of future means for commodity prices and for commodity stocks. Portfolio analyst last week, quite appropriately, we looked at critical metals with momentum, a lot of analyses, some good, some really good, and some not so. So that was portfolio analyst last week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.